What did regulators do about the Wells Fargo fake accounts? Imagine discovering that a bank created millions of accounts without customers knowing. That's what happened with Wells Fargo and their fake account scandal. When this came to light, regulators stepped in quickly. In September 2016, several agencies, including the Consumer Financial Protection Bureau, the Los Angeles City Attorney, and the Office of the Comptroller of the Currency, fined Wells Fargo $185 million. This fine was for opening over 2 million accounts without customer approval between 2011 and 2015. The regulators pointed out that Wells Fargo's aggressive sales goals pushed employees to commit misconduct. The bank admitted the problem and fired about 5,300 employees, which was roughly 1% of its workforce. After the scandal was exposed, regulators demanded changes in how Wells Fargo handled sales. The bank ended its controversial sales incentive program by January 2017. That program had encouraged employees to cross-sell many financial products, often without customers knowing. The regulators also pushed for better oversight of the bank's leadership. The CEO at the time, John Stumpf, resigned in October 2016. He gave up tens of millions of dollars in compensation as part of the accountability process. The bank's board separated the roles of chairman and CEO to improve oversight and prevent future issues. Regulators didn't stop there. They imposed civil money penalties and required Wells Fargo to pay restitution to customers harmed by the fake accounts and wrongful repossessions. The Office of the Comptroller of the Currency also assessed extra penalties for violations of the Service Members Civil Relief Act. This law protects military personnel from unfair banking practices. In 2020, Wells Fargo agreed to pay $3 billion to settle criminal and civil investigations related to the fake accounts and other sales abuses. This large settlement showed how serious the misconduct was and how long it had been going on. Overall, regulators responded by fining Wells Fargo heavily, demanding reforms, and making leadership changes. They also pursued criminal and civil penalties to hold the bank accountable. These actions aimed to protect consumers and rebuild trust after one of the biggest banking scandals in recent history. This case shows how regulatory agencies can step in to address major misconduct in big financial institutions.